Okay, traders. Now, welcome to the trading the non-farm payrolls presentation here. Right now, this is basically not to sort of put you off trading the non-farm payrolls, but just to understand where the risks are, right? And it sort of draws different information from different parts of the courses. So it's a nice one to run through because it ties a lot of components together. Trading the technicals, trading the fundamentals, and almost it's almost on the verge. Well, it probably is for most traders. Sort of advanced trading, understanding the sequence of the release, what you need to be thinking of, where you can reduce your risk, and all these sorts of components. So the let me just sort of get into it because this isn't once again meant to be a long-winded sort of presentation. It's more around just opening your eyes. So, whether you choose to sort of have a look at the non-farm payrolls, of course, if you're in the North American session, you'd be awake. It's a big prime time. It gets lots of media attention. It is one of those numbers that just stands out, right? So, and this is part of the whole media circus, right? What they don't tell traders is some of the problems, okay, of trading this number. There's numerous numbers coming out at the one time, and you're supposed to sort of, think, quickly and think, well, do I buy or sell here, right? There's a whole range of numbers coming out, and that's just one part of it, right? There's two issues. One is the large number of data, and two is the liquidity pool, how it disappears just before the release and sort of reappears about 5 seconds later. And you're like, whoa. And you look at your charts over the course of history around the non-farm payrolls, you can generally see somewhere between a 50 and 80 point sort of blip on your charts. And you're like, I didn't see that. That didn't happen. I can tell you it did, but you don't see it because it's sort of instantaneous. That's where the liquidity disappears. And then it finds liquidity at the extremities, and then it comes back together again. So that's the problem. But outside of that, you go back to the days of, I'm talking prehistoric, right? Like days before internet and those sorts of things. Non-farm payrolls was a good number to hit because it was just based off the non-farm payrolls number itself and the unemployment rate, right? These are the just two numbers, and these two numbers here are still the two core components that you need to focus on, right? There are a range of other numbers here, right? Private payrolls, manufacturing, government. Yeah. Like, who cares, right? They make up the full picture, but they are not the two big dogs, right? And what has come into play over the last number of years, probably 2, 3 years, maybe four, average earnings. I think the UK started bringing it out, right? Because unemployment wasn't moving, or they're trying to get a little bit deeper inside the unemployment numbers to see, are people making more money or less, right? Because if there's no change in employment, they're trying to work out, yeah, we've got full employment, but no one's really getting paid. So that's something to consider. I think at the moment, it's like the third number here that, we have a look at once we've already got the position on. Now, so just we've got these two numbers. Now, if you are trading the non-farm payrolls, actually, let me just get the calendar up because it's got the data on there. Okay, so just coming down the bottom here. Now, where are we? Oh yeah, we've got unfortunately, the Canadian employment numbers. And when I say unfortunately, I'll just cover this while we're getting into the non-farm payrolls. The employment numbers out of Canada are a great number. There's not as many numbers as you do get with the non-farm payrolls, and it's identical to the way the Australian numbers are released, right? You got the employment change and the unemployment rate. Okay. Now, out of that, the full-time component is more structured, so that adds extra weight if they do break down full-time versus part-time with the employment change, right? They sort of break it into two components. That gives you greater knowledge around, wow, like we could have a really good number here, but if the full-time number is really weak, well, that's going to have a negative impact on the release, right? If you didn't know that, you're sitting there long, CAD, thinking, oh, I'm on a winner here when it's tanking. And you're like, what's going on? Well, it's the full-time component. So, but just like the non-farm payrolls, employment change and unemployment rate. Okay. The change is the number one thing, right, that we are looking at. So, but the problem is here with every second month, the Canadian numbers come out at the exact same time as the US numbers. Now, you can imagine and I've had some great trades here where you're trading dollar CAD, right? Because you've got both instruments here. Okay, you got the US numbers, you got the Canadian numbers. You know, you get stronger CAD numbers and weaker dollar, you get a 150 point move. But you know, the way the economic cycles are going, it's a little bit sort of disjointed because we've hit this sort of plateau with the interest rates and inflation. Sorry, so it's sort of like we're sort of sitting here wondering what's going on. And unemployment's sort of one of those carrots that starts dangling around the place. So for you to get big variance in both the right way is a hell of a lucky situation, right? So, but what you can do is you can get very discombobulated price action. And if you are trading dollar CAD, you can get kicked out of that without even doing anything because the price just widens out. If you've got strong CAD numbers, strong US numbers, it sort of discombobulates. Traders don't know what to do. So to me, you're either trading the Canadian numbers or CAD crosses, right? CAD crosses for the employment numbers, for the Canadian numbers. Probably stay away from dollar CAD because it's just too overloaded with risk. Now, back to the non-farm. So you've got the average earnings numbers, right? So I'm saying that's the third number to look at, right? The third numbers. You've got the non-farm payrolls. And as the name says, you know, like everyone's talking NFP and everyone's wondering what the hell are non-farm payrolls. Well, the farm component is so massive and so variable, right? With the seasons, they take it out, right? So this is the payroll change, take out all the farming and everything else, right? Just as a general heads up on why they call it the non-farms, right? So you've got the non-farm payrolls. This is the main game. The second game is the unemployment rate. Now, if you are trading, right, the forecast here is 130. The range of the data is 75 to 190, and the previous number is 177. Now, that's good to know the range, obviously, so you know if the outcome comes outside the range, well, you're going to get a more sustained move, and that's good to know because if you've got a position on, you're like, do I hold it or do I not? And you don't know. But if the number if you're long dollars and the number comes out at say 220, right? It's above the top end of the range. You're long, you're like, and you see it sort of drift back a bit. You're like, no, I'm holding on here. I'm holding the position because the numbers tell me that this thing is going to go up. Okay, so that's just one component. Now, let's just focus on the actual release and if you are trading, what you need to be looking at. Okay, so number one is the non-farm payrolls. Number two is the unemployment rate. You hit the market based off this number here. That is it, right? You don't look at all the other numbers. You go with the non-farm payrolls. And this is where what the initial reaction in the market will be based off that number. Now, obviously, as I mentioned, the range here is very important. But if we get weaker or stronger numbers, the dollar will react to whatever the number comes out in relation to that. So above 130, you know, and you sort of you're looking for like at least 20,000 difference, you know, like 150, say, and under 100, you'll get a move either way. Okay, so let me just sort of draw that on the screen. Okay, so less than 100, and you're looking at it greater than say 150, gets it rolling. And that's where the reaction is. When you trade, you hit the market based off that number, right? So now, would I use pending orders? Well, you can, but it can discombobulate because you might get a weak or strong non-farms and then the opposite number for the unemployment rate. We want ideally these two numbers to be the same way, either stronger or weaker. All right. Now, if one of them is exactly the same, that's fine, right? It'll just go off the one number. So say the non-farm payrolls comes out at 150 and the unemployment rate is at 4.2. That's perfect, right? You don't have to worry about 4.2. You don't have to worry about the unemployment rate at all. You just focus on the change. And then you'll be thinking, well, if the number comes out at say 150, you've only got one real component that is better. So it's not like a double whammy where you get both numbers. You got a double impact if the numbers are strong and the unemployment rate is better, right? And that's the other thing. Do not get like this will happen to you a few times as you get into trading, right? You're looking at the non-farm payrolls. Okay, you're looking for a stronger number. It comes out at 150. You get long dollars, and you see this at 4.3, right? And you're like, oh, that's good. We've got a higher unemployment rate. Well, that's actually, as you would think, is a bad outcome and drives things down. So just make sure you're thinking at the time of the release, and we used to do this all the time, just so your brain doesn't mess things up. You're looking for a strong number here, and we are looking for a weaker number here, right? So 4.1 for example, on 150, that's a good strong outcome. Okay, and you get a bit of a double move because both of them are improved. Now, so just coming back to the initial component, the numbers come out. You hit on this number, right? You hit, then you have a look, see what the reaction is. Then you come back and go, okay, what is the unemployment rate? Now, this should take roughly couple of seconds, 2 or 3 seconds for you to go, okay, the number's 150. You get long. Now, are you using pending orders? You can do, but I would be using something like 15 points away. In actual fact, I like to take control, but quite often, if there's a big variance in the numbers, then you miss the whole opportunity. But if there's big variance in the numbers as well, and you've got pending orders, you get slipped 20 or 30 points. So there's not a great outcome. The best outcome here, right, for you to be holding a position over the non-farm payrolls is a number. Say we're looking for strong numbers, right? The outcome is 130. You actually don't want a number above the high end of the range, because what that does is that creates extreme volatility, and that's where you get gapped, right? So ideally, a number around 150, 160, and 4.1. That's your good outcome, because you're not going to get this crazy price action that's going to blow you up, right? It's very hard to sort of work out. So, and I'll keep repeating this, but you hit on this number, right? Consider the range. Then you look at the unemployment rate and see what that is, and then you make a decision. So if you go long, right? Say we get a really good number, or say it's 150, like I was just using as an example. Then you come back and we've got 4.1. You're like, okay, this is good. Okay, where did I get in? Right, and I'm going to come into this because there's a technical side of this as well. Where did I get in relation to the technicals, and where was the market? This is one of the key things. Where was the market just before the release? Where it is very important, because if we get strong numbers and it goes up and goes back down below where it was at the start, it's over, right? And the thing will get hammered. That's just the way it works. Now, on this component, say we get long, we've got a 150 number, and you're like, okay, I'm long dollars, and the number comes out at 4.3, right? What do? You close out immediately, right? This is a mismatch. You got a better non-farm payrolls, weaker unemployment. You close the position. Don't even look at where it is, right? Do not sort of think, oh, I'm going to manage this. No, you're out, right? So you have very clear rules for you to execute, right? And that's what you've got to be doing, right? So if there's a mismatch, you close the position. If you're looking to get long, right? Well, okay, is everything in your favor? 150 is a good number. If this comes out at 4.2 as expected, still good, right? You don't have to worry about the unemployment figures. So you understand what I'm sort of talking about there with regards the clinic? This is like a clinical approach. It's like going into an operating theatre at the hospital, and you're like, if I see this, I'm taking that kidney out, and the poor guy's going to probably drop dead.
I use a post-it note next to the numbers.
Yep.
So I'm not having to think at all. I can just see what numbers pop up, and then I know whether I'm going or not, because otherwise you start looking around at other shit and get distracted. And
so this is a good point. Gav, that's a great thing to do. And I'm telling you, all the guys at the banks do that, right? They've got shit, they've got post-it notes all over their screens. Don't trade if it's not 150 or 160, right? You could be
Mm.
looking, as I said, I usually look at one side of the market, and I'll come into this because this is a key part to trying to work out what's going on, what side you should be focusing on. But you just got to, like, for the last 5 minutes, keep saying to yourself, you've got to have a plan, right? And as I said, you need sort of slightly stronger numbers. So the plan might be, and I'm just using, actually, you know what? I'll go the other way because the overall trend is down, right? The long-term trend for the dollar. So if I'm going 100 or less, right? And I want, so this is the plan. I'm going to sell or stay short dollars if it's at 100 or less, 75 being the low end of the range. And you know what? If we get 4.2, I'm still short, but I'll see how the price action is. And if it stalls and doesn't do much, I might close out. If it's 4.3, okay, I'm going to stay in the trade. And I might add to it if it retraces a little bit, get extra short. So that's what we're looking for. So you're looking for a double whammy, usually. You're looking for those two numbers to line up. If they don't, well then you've got to have some rules for yourself for this event because you can otherwise you can get emotional, just let it go. If we get 100 less than 100 and we get 4.1, you're out, right? So all you got to think of is the number. What is this is the forecast. What number gets me into the trade? What number triggers me to trade? So, and that's one component. Now, let's just look at the real like what we should be doing as far as the technical side. If you don't bring the technical side into this, you are going to get chopped up, right? Just a matter of fact. Now, what we're looking for, you really want technical levels to work with. Now, and you guys would know that. And I'm going to refer back to some parts of the course here, like understanding the liquidity pool, right? Around the big events, right? The liquidity just disappears, right? And Jerry, may not be aware of this, but that's one of the key components of trading the economic numbers. The whole globe wants to trade at once, and there's just not enough liquidity. And when the banks pull their liquidity because there's higher risk on for them on providing liquidity, that's where it all gets a little bit messed up for about 5 or 10 seconds, or maybe five, like 2 or 3 seconds beforehand, say 2 or 3 seconds afterwards, anything could happen. So with that's the problem, right? But when we look at the charts, there's still liquidity around the trend lines, even at the time of the release, right? That's the thing. The liquidity at the trend lines stay there at the release. So in this situation, right, we've got euro and it's trending nicely to the top side. Now, if I want to get long euro, right, we need a weak dollar outcome, right? There's no real entry levels on the top side here, right? This is the hard part. You're like, oh shit, if we get weak US numbers here, euro's just going to go up. You got to try and work out how to get in, and this is where the trade tools come into play. But I'll tell you what, if we get strong US numbers, we've got a great level to get short here. Okay, so usually the technicals, there's two aspects, and I'm on the daily, on the hourly charts here, but let me come into the daily chart. Now, you look at the overall trend. Now, is this non-farm payrolls going to change the trend? No, it's not, but it is a mean and cranky number, and it will give people something to think about. Inflation is the key number, right? That's the trend changer. So this is one of those numbers that will kick people's heads in if it's a little bit variant. So the overall trend here, and you've got the dollar index obviously going down, dollar Swiss is going down, the beast, it's going down. I mean, dollar CAD's going down, and then you got these two suckers on the downside here, like just I don't even know what they're doing, really. It's like they're out of the loop. Aussie and Kiwi just hammered, right? They are just in the doldrums. They will bounce back very aggressively, but I don't know when it's going to happen. Okay, so overall, the dollar's going down. So to me, the easiest trade for the non-farm payrolls is with the trend, right? So we're just looking at the sort of numbers here. You're like, okay, so the whole thing's trending down. So if you don't know what to trade, come back to your charts, right? That's the sort of key essence of it. Then you can come in and where we do most of the execution on the hourly charts, right? So you've got your daily levels, you've got the hourly levels. Now, what you want to be focusing on is, and this is like as a matter of fact, right? When I was saying like the overall trend, right? So let me just come back and just show you this because it's sort of a little bit important. See where like euro is here, right? It's at 114, say 40 or 50. Now, let me get my little pen. So 115.50. The long-term trend line is down here at 111.80 or thereabouts, right? You could almost argue that there's the new sort of trend support here, a new sort of level here with that low, even at 113, right? That could be the new support trend line. That's 150 points away. So really, if we got stronger numbers, it's got to do a lot. It's not going to go down through 150. But you come into euro on the hourly charts, there is liquidity here, and it's only like what 30 points below the market. We get really strong numbers, so up towards that 190 level and say 4.1. Well, the dollar is going to have a good run. It's going to flush out some positions, short-term positions. And where will it do it? It'll do it on the hourly charts. So there is potential here to make cash out of this trading opportunity here. The more sustained move is an up move, right? It's just going to move. There's no sort of resistance levels. It just keeps going. Harder to get into the trade, but analytically, if you are, we're like trained assassins, right? So you're looking at the market and going, right, I've got a trend line here. We get, and this is the best thing, as I said, with the trend line below the market here, this it's almost ideal because we don't have to necessarily, you don't have to worry about the release, right? I mean, if the numbers come out really strong, by the time it hits this, it'll probably hit the trend line, bounce a touch, and then break through. You only want to be trading this if it breaks through the trend line, right? That's where the clean out will occur. Outside of that, it's just going to sort of bang around the place. So there are opportunities both sides of the market depending on what you've got. So this is a situation where you could be using. I wouldn't worry about Gorilla Trader, right? For the release with the trend line there, I would be setting up Trendline Trader, right, to get us into the trade. That is all you need, okay? And because it's sort of 30 points away, it will have time to react, right? Because it's, with Trendline Trader, there's a sequence of hits the level, checks the market, and then sets the position. So if you had it 10 points away, you've got no chance of getting executed, but here you can, right? So to me, like, and this is all you do on your pad in front of you is you go through the currencies, right? And you can actually do this before you go to the non-farm payrolls. So one of the sequences is maybe on your pad is, okay, so what's the dollar doing? And you go, dollar Swiss, dollar yen, dollar CAD, euro, sterling, Aussie Kiwi, and you just go, well, this is the trends. Down, 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 up, and Aussie Kiwi, nothing, right? Then you come back into your charts and go, all right, so these things are going up. So the easiest move here on the hourly charts, without getting mistaken, euro up, sterling up, dollar Swiss down, and check out dollar Swiss. It's still bloody gorgeous here. The beast, okay, it is doing a bit of extra work. I tell you, like dollar yen, seriously, it's like going into a UFC fight. Not that I've been in one, but I could imagine that's what it's like. You're just going in there, there's no rules, and you get it right, you clean up, otherwise you get flushed out. So dollar Swiss is a bit more user friendly, but there's less liquidity, right? It's like Kiwi, right? Very Kiwi and the Swiss, two out of the big major currencies, the smallest liquidity out of all of them, out of the rest of the majors. So now that looks very good. I've got levels both sides of the market there. There's potential for opportunities both sides. Now the overall trend is down. So first of all, you're like, well, that's okay. I should be looking to sell dollar Swiss, buy euro, buy sterling. Do I sell dollar yen? Maybe. That's one of those maybes. Dollar CAD. Well, that's sort of out of the game, right? Because you've got the Canadian employment numbers and the US employment numbers. There's too many variables to seriously get in there. But the CAD crosses, I can tell you what, who will trade the CAD crosses? Canadians, right? That's their home country currency. That's what they'll be trading. I'm not even worried about Aussie and Kiwi. They can get lost at this point. So that's where you are, right? So you look at the overall trend on the daily charts. You come back and have a look on the hourly charts and go, right, which of these have good opportunities? And all you're looking at really is the trend lines. So you're like, okay, euro downside. There's no levels on the top side. Doesn't mean you don't get long, but just this is the routine you would go through. And you're like, well, I've got a trend line support here on sterling. I'm not looking at that, not looking at that. Dollar CAD's out. You might be sort of looking between these two and thinking, what do I do here? I'd be sort of leaning towards dollar Swiss. You got a potential here, both sides of the market, right? The overall trend is down, but potential there. So you're looking at these three pairs, right? A little triangle here. The Then you can come back and go, all right, okay, so this thing's euro's trending higher, sterling's trending higher. How can I get into the trades there? Right? And you seriously have to. What I would do if you're just starting out and learning how to trade the markets, this is one of the hardest events to trade because of the number of variables, but it can give you a hell of an account boost if you get it right. And what we say by get it right is the numbers come out perfect for us, not too extreme, stronger or weaker. In this case, weaker. The trend is your friend. Always look for that trade if you're not sure. So you can be looking at sort of variables here. So say for instance, we're looking at the last part is looking at the numbers. And I know that we did that first, but it will set us up. Just explaining how to hit the market is one thing. Now you're looking at the market and going, okay, so what would you do here? Actually, I'll throw it to you guys. Say Euro's at 114.50, right? We've got trend line support here. If I just get my cursor on there. 114, say 15, 114.15. So 35 points on the downside is a support trend line. Now, how would you guys think about, just off the bat, how would you get into this trade? If we were, say we got weaker US numbers and a weaker unemployment rate, because this thing will take off. What do you think?
As in which instrument you would use.
What instrument you would use, or how, yeah, or how would you like what? Okay, so yeah, what instrument maybe, or what level?
Mm.
Just think of the liquidity pool, right? It disappears. Okay, so when it disappears and it comes back online, if both numbers are weak, it'll stay on the high end of extremities, right? The and if it's the other way around, it'll do the opposite. So we've got it. This is where you look at the trend lines, right? And you're like, Jesus, that's easy. It makes it so easy when there's a trend line. So what we can do is you can come back and have a look just at the market. See if we can actually find. Let me just have a look at the daily chart. See if we can find any levels up here that give us some sort of trend line, because you can sort of see if we get a trend line above the market here going back however long it is, we will find a trend line. Okay, and that can serve the purpose of giving us a level here. So back to 2014. Uh-huh. Right. So this is part of the key of just being a little bit thorough with your trend lines. So what are we looking at here? 2008, 2009. I'll fix that level up in a second. Okay. Probably didn't need to do that, but okay. So I'm just going to give this well, I can't see that. Let's just go darker. Okay, this is the top side level, and it's pretty much the ultimate level, right? It's from the very high to the most recent high. It's not like awesome, but it's the only one we've got, right? And let's just have a look where that is. 115.35, or thereabouts, 34, right? You're thinking, oh, right, okay, Jesus. Then from here, right, if I come back to the hourly charts, and when it's in a situation like this, let's just get this thing to think about it. You can like, okay, you just need two points on your chart to start drawing trend lines, right? That's just an actual fact. Let me just, what are we on here? Hourly. I think it's trying to just compute the data again. The oops. Okay. So what you can do is, so you got this most recent high, right? That was like over like yesterday. So we're looking at that and you're thinking, well, what have we got here? Well, that high does come into play, and we do have the previous high here, which was on the like the 16th or something of where are we? Looks like April, I guess. Because this is what the guys at the banks will be doing, right? They sit there and they're like, where the hell is a good place to get in here? Right? And you're like, yeah, right, okay. On the hourly charts, we're like, um, I am on the hourlies here, aren't I? Yeah. Okay. So draw all your trend lines, try and work out where to get in, and then you can start working out where to place orders in the market here, right? So 114.16. Let me just widen that out. Then we got a level here at 114.93. You know, it's still 45 points above the market. So you're trying to quantify where you can actually get into the market, where there's liquidity. So by the time it gets to 90, you'll have liquidity. What I would be generally saying is if you're looking to get into the market, right, there is a bit higher risk because you've got two variables, liquidity pool disappears. I would be looking sort of 15 or 20 points away from the market, right? That's where a little bit of safety is. Now, if we get a really strong employment change and or a really weak employment change, and then a much worse unemployment rate, you can get kicked in and then get kicked out, right? You get kicked into that level, and if you've got a 40-point stop loss, wherever it might be, you're probably flushed out on the spike, right? If you want to be a part of the move before the numbers and you want to use pending orders, I'm telling you, like minimum 15, I'd say 20 points, right, from the market. If you want to, like, I can tell you also that there's not many resistance lines on the top side here. You could basically, if we get really weak numbers, it's going to be up here anyway, and you just trade the break of the most recent resistance line. All right. Now, I'd be sort of giving that a hint of orange there because it's not like, don't get confused. That's not like an awesome trend line, but it's the only one the market's got. So the market will draw it and they will trade it. Okay. So that's sort of it. It's more about around how to get into the trade when there's no trend lines. And then you can go into your charts as I've sort of done. You can go back through and have a look and see where everything is. Now, this is, as I said, this is not a trend changer, right? We get really strong numbers. Yeah, there's a trend line here. It will flush out the positions, and there may be 30, 50, 60, 70 points there, right? And that is cash, right? So if you're sitting there and you see extreme numbers, you're like, I might as well have a piece of that, right? That's something that you can do because it's got 35 points to move through it, and that's where it is. Now, let's just say the price action is right at the trend line at the time of the release, right? The problem is the market will be taking out the stops as the liquidity disappears, right? At that point, you're almost out, right? If it's sort of just through the trend line, you've lost your entry levels on the downside. Okay, when this trend line breaks, stop losses will be triggered. So if it's close to that, as liquidity disappears in the last, say, 10 or 15 seconds, the bankers will crush it through that level. It may drop 40 points before the announcement, right? Then the numbers come out weak and it shoots back up here. And then I'll tell you what happens. The sales teams at the banks are on the fund managers and all the corporates, and they're going, you mongrels, you stopped us out. We know you did. I've spoke to Deutsche Bank and they told us that Citibank were fucking crushing everything. It's like, dude, the fucking market was there, right? Don't put your orders where the carnage is. So anyway, that's the sort of shit we used to deal with every other day. But as a proprietary sort of trader, you're looking to sort of manage the risk around this. Okay, so just coming back, right? I know I've sort of gone through a lot of stuff there, but I mean, you can sort of go through the video and watch the sort of explanation again. The easiest trades are where the trend lines are. Okay, that is just a matter of fact. Okay, so if you're looking at the markets and you're like, yeah, righto, and it doesn't really go with the overall trend, right? Selling euro, right? That's like what we want to get long euro, but we're trying to sort of fit the picture because on a number of these pairs, right, euro is going up. So ideally, yeah, I want to be buying. Sterling's going up. I want to be buying sterling. So stick to the principle of go back, draw some trend lines, try and quantify where the big level is on the top side. At least give yourself 15 points. I'd say 20 points would be better if you're using a pending order to get into the market. The easiest trade is with the trend. So looking to get into dollar Swiss on the downside. Okay, sterling top side, euro top side. That's it, right? Now, you would know, and Gav, you were just saying there before about using your post-it notes to sort of put the numbers up on your screen, right? So can you, and I've done this for years, and we used to sort of sit there. So I had the luxury, right? When I'm say at Citibank, New York, I'll have one kid on one side. I say, I'll tell you, I'll yell out sell or buy, and I'll have one kid on my left selling. I'll have one kid on the right with his finger on the buy button. And I just watch the numbers and I just scream out, buy. And the kids just starts buying, right? Can you imagine? That's what you need, right? So you don't have to worry about execution. I've got two triggers there and the kids are shitting themselves and they're like, ready? 5 seconds. Sell. Shit. The numbers are bad. Buy. It's like there's no win. But that's what the bankers do. They actually get different team members to actually do the thing. They make the call whether to buy or sell, right? So and this is the thing, I would call out buy or sell depending on this number, not the unemployment rate. That's the secondary number. So it comes out at 75. Sell dollars. Sell. Boom. Let's go. And so and if you had like some of the other guys would be sitting there, you're like, right, you do euro, you're on sterling, you're on Aussie and Kiwi, whatever. And like you'd have different people doing different things. And if I yell out buy, this is what I want to happen. Okay, sell euro and sterling. So you know when you're going to post it note the thing, your orchestra. It's like conducting an orchestra. Like seriously, you're like Johnny. You're euro, right? Get ready. Billy, sterling, and you're like getting all this stuff. And the anticipation of the numbers, it gets to like fever pitch, right? You're like, it's like this is like the grand final, the Super Bowl. You're like, last play of the game. Let's do it. I used to get so worked up. But so just focus on that. So you hit here. Now, what will take a bit of pressure off this number is knowing what the trend is, where the trend lines are, right? So all you need to do is plan the opportunity. Now, as I said, there's a lot of things to think about. So when you come back to the markets, and if you're trying to cover both sides of the markets, and this is where we can use trade tools, as I said, you could set up Trendline Trader here, right, to execute on the downside for euro. And you can have it so it expires 15 seconds after the numbers, right? The Trendline Trader on the downside of sterling. And then you just look at either using T-Rex or a pending order up here. Now, I would generally, because the numbers are so big, I'd probably place two smaller orders, pending orders on the top side. Okay, and let me just get this. I'll get MT5 up and just show you. Because the...
Incoming man.
Okay, so let's just get this up here. Okay, so what I would do is, if I just come down to T-Rex. Okay, so turn the trade cross manager on. So you're looking at euro and sterling. Okay, turn it on. So if I place an order here, right? So say I'm looking for a buy stop, right? I'm looking to get into the market. So say I put this order 20 points above the market. Now I don't need to have both charts up. I can do this with T-Rex with just one. Okay. So what I would do is just place the order, right? So trade. You got the two orders in play. Now, if you're doing this, right, all you need to do is have the number, you'll have it on one of your screens, right? And you have the number in your head what you need, right? So for this to go up, you need a weaker number, right? So you might be thinking, you know what? It's got to be under 100 or less for me to stay in the trade. So you set up the orders here, you get them in the market, and what you do, because they're already there, you come back. Let me just change the color of the pen here. Okay, here we go. All right. So all you have to do is either close pending. You can just hit close all, right? So you don't sit there and do anything else. You look at this number over here, and if it comes out 100 or less, you do nothing. If it comes out at 110 or 120, all you're doing is you don't have to think about anything because you've already got the orders there. You just have your cursor. Let me just clear the screen on close all. So you're not looking to buy, you're not looking to sell. The orders are already in the market. You've got trendline trader covering the downside. You just sit there and it comes out 120. Boom, just hit off. And that'll close the orders. And that's all you need to do. So you don't need to worry about going in and placing buy orders at the time of the release. That would be buy stop. So does that make sense to you? And don't forget, I'm actually taking this to sort of the level where I would be doing multiple executions. You guys, I would probably suggest you just focus on one instrument, one pair, and pretend if this is your first time trading on-farm payrolls, one pair with one trade, right? That's goes with the trend. It comes with a bit of higher risk because there's no trend lines. Right? There is one up around 115, the figure, as we saw. There's a nice easy trade on the downside. You might just go with that. And you go, you know what? I know the trend is up, but if this number comes out strong, it's going to be an easy trade and a flush out. That is an easy trade here, right? So you've just got to make a decision around, because this is where emotions and greed comes into play, right? You could go, you know what, Brad's just talked me through this. I could, if I've got access to the trade execution tools, then I could actually sort of really amp this up. I mean, as I said, because I could have euro there, and let me just go up here, another euro chart. Okay, and then, what I'm saying is you can actually have, trendline trader, okay, inputs, break of, okay, I'm not doing that. Hit that. So you can have.
I've never actually used Trendline Trader.
Oh my God, it is, mate. It's the bomb. It is.
Mm-hmm.
Yeah, it's the bee's knees. So that's, you can see exactly where your order's getting set, and you can just sit there. You don't have to do anything really. And so you know exactly where you're going to be triggered, right down here. So if you did get really strong numbers, you're like, yeah, well, I'll just let that one go. Let's just see how this one plays out. Whereas up here, you're managing a lot of different things. You're looking at the numbers. Your heart rate will be about 160 beats per minute. And you're like, I'm like, oh, this is so intense. It's like, it can be too intense for a lot of people. And this is what I was talking about the other day, Gav, is looking at traders' psychological profile, which I'll be getting all this done pretty shortly, is that this doesn't suit everyone, right? This trade up here does not suit everyone, because if you can't handle the emotions and you can't handle the massive adrenaline rush and, the potential of making money and losing money at the same time, then that's not for you. But when you've got trend lines in play, It is, right? It's more analytical, it's more structure. This is an easy trade. This one is a little bit more difficult. But the carrot there, this is the greed part, right? This one up the top here comes with a big ticket, right? Because it goes, it's going to run, and it could get it easy, get 150 points out of that. No trend lines on the top side, maybe 200, right? Especially because that goes with the overall longer term weaker dollar trend. Okay. And then you know what? With that weaker number, they'll be sort of going, you know what? The Fed needs to start talking about cutting rates again. Trump will be telling Powell that he's going to sack him again, and like, you got to get this to get that done. So there's a lot of different things to consider around your execution, around the time of the release, right? The easiest component for me to explain to you is the number, right? It's just one number, and you just got to look at the number, trade the 130. Where are we? 130. That's the number. There's the range. Trade that, right? As the second thought, a couple of seconds later, when you've hit the market based on what that number is, if there's significant variance, as I was saying, maybe under 100 and above 150 gets you in the game. Now, you might be just thinking, you know what, I'm new to this. I just want to trade the trend. Well, the trend trade actually comes with a little bit of a slightly higher risk on execution because it's going to go up. Don't forget, you don't have to use pending orders. You can look for the initial spike. And actually, let me just cover that because this is probably a smarter one to do. So you're trading that. Say we get the weaker numbers under 100. Euro shoots to the top side. That comes out as expected. You're like, okay, I'm in the trade here. Or one other component is have a plan. So it's at 150, right? And the plan is you want to get in. So if we had pending orders, I'm saying get into the market 20 points above the market, right? Because if the weak numbers are weak, it's going to go 100 points anyway. Don't worry about any initial sort of volatility. It's like if both numbers line up or one of them is very weak and the other is as expected, it's going to go up, right? So you're here. So your plan would be, okay, well, I'm just going to get my chart up. I've got T-Rex here. So I'm going to miss the initial splurge or surge, whatever you want to call it. So it goes up like 30, 40 points, 50 points. You're looking to get back in the market 20 points above the market. So you should be thinking, you know what? I'm going to look to get in here around 70. That's my entry level, 70, 75, somewhere around there. And that's all you think about because all you have to do is see the initial move up and you've got to be a bit hard-headed with this and you think, well, it's coming back down. It's only coming down because liquidity went out and came back in. So you pick a level and you go, you know what? I'm going to get in here. Okay. And this is where you use the trend line and you're like, well, where's that trend line? Okay. Well, 114.16. Okay. So then you got trend line support on the downside and that could be your level. So if you've got, you get into the trade with say 5 lots or whatever it might be, so 1 lot, whatever it might be, 1 lot if it's your first time trading and you have a 40 or 50 point stop loss, right? Ideally you want that below the trend line and that's what you got to factor in. But I'm telling you, with your plan, you can just sit there and trade that manually by using the level. So like if I'm sitting here and I'm like, so if you see this is why, sorry, before I start mumbling, the level where the price is before the release is very important. I mentioned this at the start. This is the key level that you need to focus on because that's where you gauge getting in. Now, if the numbers come out really weak and this shot shoots up and then slowly drifts down below that level, something is wrong and it's no longer going up. I can tell you. If it goes back below the price where it was before the release, there's something weird going on and it's time to get out of the trade if you are long. But say this is at 114.50, it tells us what level to buy up. Right? I'm saying 20 points above the market. Don't have to worry about it on the downside because we've got a trend line. Okay, so that's where you can trade manually. And the fact is, if we get really weak numbers, this thing might spike 50, come down 20 to like 80, right? And you're like, and then keeps going. You're like, oh, I missed it. Yeah, well, that's That's just the market. And you can learn from that experience and go, if I had to reduce my trade size a little bit, I could have got into that trade at 80. I mean, it's easy in hindsight, right? The other part is too, and you might be thinking, oh, I should have just used a pending order. Well, let me just tell you, if it's at 114.50 and we get really weak numbers, you may have your order at 114.70, but you've been done at 85 because the market gapped that level. So trading manually gives you greater control of the risk and sometimes gets you into the trade at a better level, right? You don't know till afterwards whether you're going to get set at 70 or 85. And then at that point, you'd go, no, I don't want that one. I'm going to try and buy lower. But that's not the game, right? You don't get a chance. You don't get a second chance. You got to make these decisions. I would say for you guys trading this maybe for the first time, second time, just look for the easy trade, right? Have a plan. Trend line is easy. That's an easy trade, but it's not the trend. This is. And getting in here, 114.50, look for like a 20-point entry above the market. Now, that could be a pending order or just trade manually looking for the initial spike. It's supposed to be orange. Up, come back down. It will be here. You have to have in your mind the actual level because when it hits, you've got to do it because you'll be like, oh, no, I might get this a little bit lower. Then, boom, it's 20 points higher and you're like, oh, what a dick. I was just messing around for like 1 or 2 points, 5 points. Get into the trade, right? And that's what we're doing. Okay, so as you can see, explaining this compared to like a CPI number, it's complicated, right? So, and when it's all said and done, and if you are in a trade and you get numbers that do line up and you've got, say we've got the weaker numbers, say less than 100, right? And the unemployment rate blows out to 4.3, you're like, yes, that means the dollar goes down here, dollar goes down here. We're going to get a significant move. And then you can come back and go, wow, what were the average earnings anyway? And then you're like, you know what? These were really strong. You're like, well, that's going to like impact your overall management of the position. You might go, you know what? I was thinking this would go 150, but these are a little bit strong. It's going to take a little bit of shine off the weaker numbers. But at the same time, if these are weaker as well, you're like, wow, I think there's a good chance here for 150. And that's where you can manage the position or manage your expectations around what you're going to get out of the trade. All right. Easy, right?
It's never easy when you're actually there.
No, that's right. So this is why you've got to do this beforehand, right? Especially the plan here. You got to make two decisions. What's the plan for this? And probably first going to your charts and going, well, what am I looking at here? Right? You know, when you look at the daily charts where the trends are and where the potential is. The easiest thing to do to get into something like this is small positions because then you're still taking money out of the market. You're not going to have any performance anxiety because you are still making some cash. And the volatility, if we do get the right numbers, you know what? You're still going to make probably as much with the smaller trade because it's going to move twice as far. Okay. It's really, and I can tell you this number, and I'm talking about the managing the risk. A lot of traders don't hit it because it is a bit of a graveyard, right? With, you know, if you get the numbers discombobulating, as I said, one strong, the other weak, then that's it. One other thing, last thing I would tell you is expect the numbers to come out as expected, right? This will, and by doing that, it manages your overall performance anxiety, right? You're like, oh, because it's deflating when you do all the prep and you've got the charts and you've got your orders set up and you're like, wow, okay, here we go. And then it comes out as expected, like, oh. And I've seen a lot of guys just go, oh, I'm just buying some, you know, and you're like, why? Manage your expectations. There's three outcomes: weaker, stronger, or as expected, right? And if it comes out, so your plan is, right? You have a plan. If the number comes out, say 125 to 135 and no change here, I'm walking away. There's nothing to do. If it's under 100, I'm selling dollars. And then you go, if it's above 150, I'm buying. And then you can reduce the risk out of those two by going, you know what? If I'm only trading with the trend, so I'm just looking for weaker numbers. then all of a sudden you take out these variables and then it's like, this isn't so bad, right? When you're looking for one side and not overcomplicating it, you focus on weaker numbers. So you want to blow out here to 4.3, a number under towards 75. All you got to do then is go, what's the trade here? And you look at your euro and you go, yeah, I'm getting into euro here or sterling. Draw those extra trend lines in that I did before. So you could even be looking to get in above 114.90, right? If it breaks 115, which it would if the numbers are really weak, then it's still going to run 70, 80 points, 100 points to the top side, right? From a release, there's 150 points in it. That's the way we look at it. So there's a number of different ways. You could have a cheeky little pending here, order 20 points above the market. You could look to trade live. You could have your technical trade up the top here. But just looking at, you can see how just looking at one side of the market is easier for you to calculate in your head and easier for you to manage. Does it make sense?
Yep.
You
Yeah.
could be saying yes, just and not. I mean, there's a lot to take in here, right? This is, and as I was sort of saying at the start, there's some components here in the courses, right? Even the trade the macro fundamental releases, you can get into over this one here, trading the US non-farm payrolls. Okay, the central banks, see how the central banks are more talking about inflation than they are employment. When inflation stalls, they start really focusing more on employment. So, but they're always sort of keeping an eye on it, and that'll run you through the logistics of that. And beware major volatility around the US non-farm payrolls release, right? There's some components here in trading the macro fundamental releases that will give you just a little bit more insight in around that. And if I come into actually into the advanced stuff, you'll find some actual trade plans here around trading the non-farm payrolls around medium or high variance. Okay, so this will give you like into this one here. So you got it'll give you the actual plan as in into what's going on, right? So have a look at this. This will give you a bit of backbone around where to get in, what the expected moves are. Looking at that liquidity hub, this is where you can get a bit more knowledge. And so this is, so we got really weak numbers. We don't have a trend line on the top side here, but you're looking at that first spike, depending on the variance, how deep the retracement will be, and then the continued move afterwards, right? So check out your courses because there's valuable information there around trading the non-farm payrolls, as well as obviously trading other numbers. So check that out. You got the hikes. I was just looking for those traders who aren't up the curve, understanding the liquidity pool is another one. Just so you sort of got in your head so you can understand what happens at the time of any release, right? Okay, so plenty to so this is where having the courses as a backbone is beneficial because you can go, okay, I don't really understand what Brad said. I'll look at the video again, but let me just come in and see if I can work it out. Because when I'm doing the courses and setting those up, I'm sort of thinking about it, trying to explain it in simple terminology, and that's where we are, right? So, yeah. Any questions, guys?
On the courses, Brad. Sorry,
Yeah, John.
I'm I do that all the time. I go back to the courses, but earlier in the week I was trying to go back through some prime time trading one, and I've already done part of it, but it doesn't let me go back in. It says I'm not enrolled in that course.
Yeah, okay.
I meant to send you a message on that.
Yeah, I'll have a look because we're actually this whole system is built on a different back end system to our normal one. So we are going to go back to it because it is causing a few little hiccups like that. But
Okay.
I'll have a look because I've seen this before, and I'll go in and check your account, and it will be there. Maybe try clearing your cache, John.
Yeah.
Like clearing your history. That should do it. If that doesn't work, then just reach out on the Discord again, and I or
It's
someone will.
it's only that one course. Everything else works, which is really strange.
Okay. Yeah, that is odd. Weird. I'll check.
But I'll do that.
Yeah, I'll check your account, but just clear your cache. That should like square things up.
Yeah.
Yeah. So there you go. Right. So if you don't have Metastock workspace, you can just jump on the website and check out what's going on. The there's a few bits and pieces here. I'll be doing a sort of an update sort of shortly here, just on what's going on. Like the markets generally, and this is what you need to understand as well, coming into the non-farm payrolls, they will freeze. It's like the market goes to sleep, right? Because there's what's the point of trading now when we could potentially get a 150 point move on a specific time, right? So the markets, you might see a bit of a squeeze up or down here, right? In relation to, if the market's positioned too heavily one side, you'll start to see, say it's like there are long dollars, I mean short dollars, you might see a squeeze to the top side, right? The where it's the market moving because of the way it's positioned. But you know what? This week has been one of those ones where there's been a few little flush outs already, and the market gets a little bit pre-positioned, but not much. And I would think just with the price action here on a lot of these things, that not much will happen between now and the non-farm payrolls, unless obviously there's a geopolitical update of some sort. Yeah, and that's pretty much it. I was going to say, basically, check out the live trade signals. That could lead you into some of the CAD crosses or some of the other pairs. I mean, euro and sterling, right? They are showing very clear signs of dominance, especially over Aussie and Kiwi and the other currencies. So that's something to be aware of as well, because we're getting bullish signals here, especially Aussie, Euro, Sterling, Kiwi, dollar Swiss down. Like the markets are lining up technically really well. Okay, so and Aussie's in the buy zone. You got Sterling, Kiwi in the buy zone. The and Kiwi CAD, another one there to check out. So there's lots of trading opportunities. What you're going to do is just try and be as objective as you can. Don't get too emotional, which is easier said than done. And then just plan the trade and just execute it without trying to bring any emotions. If you go into these trades, as I said, without, say, 10 years of experience and try and trade both sides of the market with multiple orders, and not only that, trade both sides of the market, but then try and trade 4 different pairs doing the exact same thing. You can do it with our trade tools, but your head will melt. You'd be like, oh my God, I don't even know. Was I buying or selling? I don't even know. I'm making money. I know that. So
Did
that's
that
what I'm
Wednesday
saying.
night.
What's that? Wednesday
I
night?
was I was doing that Wednesday night.
Yeah, yeah. Well, you can see, right? You can get too worked up. Everyone wants to progress and make a lot of money, but you got to just do it in an orderly fashion. And the more experience you get, I can tell you at the moment, managing two different pairs with buying one, selling another, it's hard, it's complicated, and you're like, it's funny how beforehand you're like, yeah, I've got this. Then the numbers come out, and you're like, I can't remember anything, and it's so you can really mess yourself up.
Yeah, I was using what Gav was talking about, but on a pad, and I was writing down where it was when I put it on, and it was just like I basically just scalped. I got into that 135.50, I think it was
On Sterling.
on Sterling,
Well, funny
and I got
enough,
out, and I had a good night, but I could have had a better night if I'd have just stuck to one or two.
yeah, well, that's right. And there is, like, if you go through the course and get to the scalping section, when the numbers come out one way, you can actually scalp the market a bit, right? The danger is you lose the position and it keeps going. But you can
Yeah,
have two trades. One, you're getting in and it bounces 20 points, you get out. You get in 10 points lower, get out. Like the lows will get, if it's going up, when it retraces back, the initial retracement will be the biggest. Then it will go up, say 15, then come down 10, then go up 15, then go down 5. And then you know it's about to pop. So you can get 2 or 3 trades out of it beforehand, which covers your overall risk on your long-term trade maybe. So that's something to think about
yeah.
as well. All right, guys. Well, thanks for joining me. I'll get this up. I mean, there's a lot of good stuff in there that a lot of the crew will have a chance to look at. But anyway, let's just see how it plays out later on today. All righty.
All right. Thank you.
Thanks, Brad.
Thanks, guys. Have a good one. Cheers, Jerry.
Yep.
Bye, mate.